Good morning and welcome to today's webcast, Not-for-Profit Accounting and Auditing, Spring 2017 Update. Before we begin, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And welcome again, everyone. And I'm happy to introduce today's presenters from Moss Adams Government, Not-for-Profit, and Regulated Entities Group, Jennifer Price, Partner, and Ashley Osten, Senior Manager. And I will now turn the line over to you to get us started.
Thank you, Emily. Good morning, everyone. Thank you very much for joining us for our Spring Not-for-Profit Accounting and Auditing Update. What we plan to cover today is on this agenda slide. We'll go through the not-for-profit reporting standard. I know this is a very important standard for this industry group, so we'll spend a bit of time on that. We'll also go through revenue recognition from contracts with customers, and we'll touch a bit on leases as well as the standard recently issued related to the statement of cash flows. First, before we roll into the presentation, we'd like to get an idea of who's on the line with us today. Please go ahead and submit what type of not-for-profit or organization you represent. I'll go ahead and give you a few seconds to respond. And just as a reminder, if you do want to receive CPE credit today, you will need to respond to at least 3 of the 4 polling questions that we will have throughout the presentation. I'll go ahead and give everyone a few more seconds. Okay, I think everybody's had a chance to submit their answer. Okay. Looks like we've got a pretty good mix from different areas, with the other category being the largest, and a fair amount of higher education and foundation organizations. Okay, great. Well, let's go ahead and get started. We'll start with the not-for-profit presentation of financial statements. For those of you that aren't aware, this is a pretty important standard, so if you haven't heard about this yet, we will hopefully get you up to speed today. Just a little background on the reason for this standard It had been over 20 years since the FASB statements for not-for-profit reporting had been issued, and the standard setters really wanted to update that model and really take a look at what we're presenting in financial statements. They wanted to provide more useful information and really improve the net asset class information, which is very critical information in a not-for-profit organization. They also wanted to improve the footnotes, including items such as liquidity, financial performance, as well as expenses and cash flows. So hopefully this will allow for better presentation overall and will really allow you to tell your story a little bit better. So let's get started. Net asset classes. So currently in GAAP, as I'm sure everyone's aware, we have our three classes of net assets that we present. We have our unrestricted, our temporarily restricted, and our permanently restricted categories. Under the new standard, that will be reduced to just two net asset classes on the face of your statement of financial position. You'll have your with donor restriction class, which will be your perpetual restrictions or your previously permanent restrictions, and your time and purpose restricted items. And then the second category will be without donor restrictions, which is, of course, anything unrestricted, and will include your board designated items, just as those were included in restricted or unrestricted previously. So two classes. So just to give you an idea of how that might look, the minimum requirement there at the top, under your net assets section, you'll have your without donor restrictions, your with donor restrictions, and then one total net assets. Now that being said, you can add more detail. Below that, at the bottom is an example of some additional information you could show. You could break out your without donor restrictions into your undesignated and your designated by the board and total that up. And then within your with donor restrictions category, you could show your time and purpose restricted as well as your items that are perpetual in nature, and then have your grand total. So there are some options for you as to what you can do there. So what about the statement of activities? How's that going to look? Well, similar to how it's currently shown, where you are showing three classes of net assets across the columns, again, you'll just show two classes, your without and with donor restrictions. So it's pretty similar, other than it's just reducing those three classes to two. So again, there's some other options out there as long as you're meeting the requirement. This is just one example of how that might look. So what about disclosures for net assets? Well, for net assets without donor restrictions, you do have to disclose information about those board designations and purposes of those. And remember, you have to include disclosure for all board designations, not just board designated endowments. So I think that's a pretty important distinction. I think we're already disclosing board designated endowment information, so this is all board designations. And then for net assets with donor restrictions, you'll continue to disclose information about the nature and amounts, which we're already doing now, but really focusing on how the resources could be used. So not just showing the temporary and permanently restrictions separately, but really disclosing how and when those resources can actually be used. So what about disclosure for those board designations or net assets without donor restrictions? So these are voluntary resolutions of your board. So as we mentioned, of course, we're going to disclose our board designated endowment information. But other resolutions that earmark your net assets for a specific purpose need to be disclosed. Now, this is not just your blanket budget approval for the year. You don't need to get into disclosing everything that's in your budget for the year. These are actual earmarked net assets for a specific purpose. You'll want to consider year-end operating surplus designations, maybe where a board resolution isn't specific, and also include designations that are delegated to management by the board. So moving on to the next component in this standard, there's a lot to this standard. Underwater endowments, there are some changes required for underwater endowment reporting. So on the left side, we have what we're currently doing. We have our underwater amounts reported within our unrestricted net assets. And under the new issue, we have those underwater amounts reported within the donor restricted net asset category. So that's a fairly significant change. We do have those with the donor restrictions bucket. The current disclosures, we're showing how much is underwater in the aggregate. You'll continue to do that, but there's also a couple of new requirements related to those underwater endowment funds. You have to show the original amount of the gift as well as the fair value of the endowment. And you also have to disclose what your interpretation is of your ability to spend. Are you spending underwater endowments or are you not? What has the board decided? What actions have been taken related to underwater spending? So a little bit more information on your underwater endowments. So just to give you an idea of what that looks like, we've put together a little example here that I'll walk through. We have two different gifts included in the example. So let's run through gift A first. So let's say you received a $105 million gift, and it's dropped $5 million in value. So now it's worth $100 million, okay? Under today's GAAP, we would show that $105 million original gift in our perm restricted bucket, and we show that $5 million underwater amount in our unrestricted category. Well, under the new standard, we would show $100 million in net assets with donor restrictions. So that net amount is combined in the with donor restriction category. So what about the other way? What if a gift has appreciated in value? Let's look at gift B's example. You received a $75 million gift. It's appreciated by $25 million, so today it's worth $100 million. Under current GAAP, again, we show that original gift value of $75 million in our permanently restricted category. And we show that $25 million in our temporarily restricted category because, of course, under current GAAP, we show those gains in temp restricted until they've been appropriated for expenditure. So under the new standard, you'll show that total $100 million in net assets with donor restrictions. So hopefully that example gives you a bit of an idea of how that will look. Okay, moving on to another item in the standard, liquidity and availability. This item is, I would say in my own experience with clients and prospects, I have received the most questions about liquidity. Perhaps because it's something new. I don't think many organizations are disclosing something like this, so it's a bit new and different. And what it's requiring are a couple of items. There's some qualitative information required, and there's also some quantitative information. On the qualitative side, you really need to explain how your liquid resources that are available within 1 year are managed. And by 1 year, we mean within the date of your statement of financial position. And on the quantitative information, you're going to show an actual table with numbers of your total financial assets that you have available to meet your cash needs within the year for your general expenditures. And they do add a definition of financial assets, so you'll want to check that out. You know, basically, it's assets that are convertible to cash within a year. And we do have some examples to show you on this. Let's start with the quantitative example. This is sort of an intro paragraph that would precede your quantitative table. Again, this is just an example. I've seen quite a few out there. This particular example says, the following table shows the organization's financial assets reduced by amounts that are not available for general expenditures. It goes on to say when they're considered unavailable. It lists some items that they're excluding, your perpetual endowments, appropriations, anything that's set aside, so on and so forth. So it basically explains what you're including and what you're not including. And then this would be the table that follows that intro paragraph. So here's an example of this disclosure. So you start with your financial assets. You have your cash, your accounts and contributions receivable, maybe some investments and trusts. So those are all your financial assets. These are assets settled or received in cash, can be converted to cash. And then we're going to back off those items that are not convertible to cash within the next 12 months. So your receivables that are beyond 1 year, your investments that are held for others, any perpetual items that are sitting in those financial assets, your term endowments that are not being appropriated within the year, trusts that are required to be held, and then any board-designated endowments. Now, in this example, those board-designated endowments would be ones that are not going to be used within the year. So you come down to one total of your financial assets that are available to meet your cash needs within the next year. So hopefully that gives a little bit of an idea of how this might look. Again, that is just one example. What about the qualitative side? Here's an example of a qualitative disclosure regarding liquidity. This particular example shows how many days cash an organization has on hand, how many days of operating expenses in cash. It also lists the organization's policy. So keep in mind that the qualitative side is really how the organization manages its liquidity. What is the organization's own policy? This disclosure also offers that the organization has an unsecured line of credit available that could be used in the case liquidity was needed. So again, this is just one example. There's no requirement to show 90 days of operating expenses. I've seen quite a few examples out there, but hopefully this gives you a bit of an idea of what to think about and what to start considering for your own internal policies. Okay, expenses. Another significant item in the standard. There are some new requirements related to expense reporting in the new ASU. You will be required to present a functional expense statement or show your expenses by function and nature all in one location. But you do have a couple of options for how you do that. You can include a table in the footnotes. You can include a separate statement. And I know many organizations already do include a functional expense statement. And you can also include it right in your statement of activities as well. You can just show it that way right on the face of that statement. So you do have a few options for that. You do have to describe your method used for those allocations you're making to various categories. And there is some new guidance on management and general expenses, so you will want to check out the guidance on that and make sure that you're categorizing things appropriately. So we do have an example for this as well. This is an example of a functional expense statement. Across the columns at the top, you have your various programs, A, B, and C, whatever your mission and whatever you're operating in. And then you have your supporting activities, which typically we see your management in general and your fundraising. and then you have your grand totals for those. And then the rows going down the side is your natural classes of expenses. I've had a lot of questions on how many natural classes there should be. I don't think there's an answer to that. I think it really depends on what's meaningful to you as an organization, what's important, and what you feel your board and your users of your statements really would like to see. I think if you have too many, it could be a bit much, but I think that, you know, it's really up to the organization to determine what's important. Okay, we're going to take a moment to do another polling question. So out of the 4 items I've just covered related to the new ASU, which section do you feel will really require the largest amount of time to implement? Is it the net asset classes? Is it the underwater endowment information? Is it that liquidity and availability disclosure? Or is it the expense reporting, the functional expense information? So go ahead and just give people a couple more seconds to go ahead and give your input on that. Okay, I think everybody's probably had enough time to think that over. Let's go ahead and move and see what the results are. Okay, liquidity being the highest, and that definitely would have been my guess. As I mentioned, I've had the most questions about that, and I do think it's a little bit of a subjective disclosure. So that is not real surprising. Expense reporting being the next one. Okay, that's great information. Let's go ahead and move on. A couple more items in this new reporting standard. Restrictions on property, plant, and equipment. For donations or contributions that you receive that are restricted for the purchase or building of those fixed assets, this standard removes the option to apply a time restriction on that contribution. So it really removes that option to release that restriction over time. So everyone will now have to use the placed in service approach. So you're releasing that temporary restriction when you put that asset in service or when you're building that building. I don't think this is really significant. I know in my client base, I don't think I had any clients that were implying that time restriction. Most were releasing that restriction when they put that asset into service. So hopefully that's not too much of an impact for most organizations. Investment return. There are some changes to investment return reporting. You will be required to show your investment return and your investment expenses on a net basis instead of separately. And so investment expenses do include both your external and your direct internal expenses. So not just those outside investment fees, but any internal direct investment expenses as well. But keep in mind with the direct internal expenses, these are really salaries for those folks that are really involved in generating the investment return. So you're really developing or executing on the investment strategy, selecting, monitoring investment firms. This is not just, for example, the controller or the CFO doing the accounting for those investments, doing the unitizing of the endowment. This is really true investment management. The standard also eliminates the requirement to disclose gross investment income and expenses in the footnote. You're allowed to keep it if that's something you're used to seeing and you feel it provides value or your users like to see that, but it's no longer required. Lastly, in the standard, the statement of cash flows. There was some discussion when they were working on this standard about requiring a direct cash flow statement. They've decided to allow you to continue to use the direct or the indirect method. However, if you are using the direct method, you no longer have to do that reconciliation to the indirect method. That's now optional, so you can keep it if you like to see that, but you can go ahead and remove that if you don't feel, if you're doing that direct cash flow and you don't think it has any value, that can now be removed. Okay, what about timing on this standard? Let's talk about the timing. So the effective date is fiscal years beginning after December 15th, 2017. So if you're a calendar year in, it's your December 31st, 2018 year, or for your fiscal years, you're a May or a June, it's going to be your May or June 30, 19 year end. Early adoption is permitted. There are a couple of transition requirements you have to consider. So in the year of adoption, you're of course required to apply all provisions. Now, if you are presenting comparative statements that year, you can choose not to present the functional expense statement and the liquidity information for that prior year comparison. So again, you can leave out those two items just for your prior year comparative information. If you choose to early adopt for this coming fiscal year, this June 30, 2017 year, you would apply all provisions, of course, and again, for your prior year, so your 15-16 information, if you show comparative statements, again, you could leave out functional expenses and you could leave out the liquidity information. So it does give you the option to not have to do all of them if you would like to get a jump on this. Couple important notes to remember. There are many items in here you're already permitted to incorporate. You can always disclose additional information. The only changes that can't be done without formally adopting, you can't change your net asset class presentation. You can't combine those temp and perm restricted categories without formally adopting the standard. You can't change your underwater endowment accounting or eliminate those investment return disclosures. And you can eliminate your indirect reconciliation for your cash flow statement if you are doing a direct method. So if you want to do those items, you have to fully adopt the new standard. Okay, let's do another polling question. And we would really like to know if any of you out there are planning to early adopt the ASU. Let's go ahead and give people a moment to answer. See if there's anyone ready to get ahead of the curve. I know a few organizations that are planning to do it. Okay, that should be enough time. Most are not. Okay, 13% are. That's good to know. And a fair amount don't know yet. Fair enough, fair enough. Well, thank you. I'm going to go ahead and turn it over to Ashley at this point, and we're going to switch gears to a couple of different standards.
Thanks, Jen, and welcome to everyone again. Thank you again for joining us. So first, the revenue recognition standard. So that standard was actually issued back in May of 2014, so 3 years ago. And it was really the result of a convergence effort between the FASB and the International Accounting Standards Board. It took the standard setters nearly 10 years to develop the final standard, so it was a long time in the making. And one of the biggest changes is the move from rules-based accounting to a more principle-based focus. The standard setters really believed that this change would improve comparability of revenue recognition practices across entities and industries. So this slide is really just going over a quick timeline. In May 2014, the standard was issued, and then in August of 2015, a little over a year later, the FASB said, let's defer the effective date for 1 year. In March of 2016, the FASB clarified when an entity is acting as a principal versus an agent, and they also added several examples to really better illustrate the application of the guidance. In April 2016, the FASB amended the licenses and performance obligations guidance within the standard. And in May 2016, they allowed for several narrow in scope improvements and practical expedients. And then finally, in December 2016, there were 2 accounting standards updates issued, which provided for various technical corrections and improvements to the revenue guidance. So there's been a lot of change ever since it was issued in May 2014, and this set of slides is really encompassing all of that information. So let's dive in. So we've heard really from a lot of our client base that many nonprofits are actually struggling with the changes posed by this accounting standard and how it will impact your organization individually. And much of the concern is surrounding which revenue stream the new guidance will apply to. As you may have heard, not all revenue streams are impacted, so many of you on the call today may receive a significant portion of your revenue from, say, contributions or investment income. Both of those revenue streams were scoped out of the new revenue standard. So what actually does apply? So the new revenue standard defines revenue as a reciprocal transfer between parties who are both expecting to exchange similar values, so an exchange transaction. Several examples include tuition payments received by a school, and I saw that there were several universities on the call, so it will apply to you, and then admission fees received by an art institution are 2 good examples. Again, a contribution is voluntary and non-reciprocal and scoped out of the standard, just like I mentioned already. And then just something to remember, if a contract has both an exchange component and a contribution component, you would have to actually evaluate the exchange component, and it would need to be analyzed under the new revenue recognition guidance. So the core principle of the new standard focuses on the contract between the nonprofit and its customers for goods and services, and more specifically the rights and obligations between those 2 parties, or a reciprocal transaction. The new standard provides for a 5-step process to recognize the revenue, which all 5 steps are listed at the bottom of this slide. And let's take, for example, a college or university's tuition and housing revenue. So step 1, identify the contract. So colleges and universities will really need to consider whether and when an agreement with a student creates enforceable rights and obligations. So in this case, it may be appropriate to loop in your internal legal counsel or your external legal counsel to determine when that right is enforceable. You should also bear in mind that a contract doesn't exist if each party has the right to terminate the contract, and I'll talk about that a little bit in step 3 or 4. And then you also must consider collectibility from the student or others paying on the student's behalf. If that contract is assessed as uncollectible, then no revenue would be recognized. In step 2, it's identify the performance obligations of the contract, the separate performance obligations. In most cases, tuition and housing are distinct services, and so separate performance obligations, pretty easy there. Step 3, determine the transaction price. So you would consider the consideration that the college or university expects to be entitled to for the student's tuition and housing. Sometimes a college or university will have different rates based on category of students, so that's what that's really getting at. Institutions often provide financial aid for tuition and housing, so you'd need to consider work study. That would be given in exchange for services and would be reported as an expense as part of the student's compensation package. And then a scholarship award, that would be a reduction of the transaction price and therefore considered revenue. It is believed that because scholarships and other aid are agreed to up front, the reductions would be recognized as revenue is recognized, so ratably. And finally, under step 3, you need to consider if the college or university is providing a withdrawal period, kind of like I mentioned in step 1. If so if a student is allowed to withdraw from classes, say 2 weeks into the class period and receive a full refund, you'll need to recognize a full refund liability. And you can estimate based on your portfolio of students rather than on an individual student-by-student basis of how many of those students you feel like will withdraw in the 2-week period. Under step 4, allocating the transaction price. So while institutions do sell tuition separately, rarely would a college or university sell housing to a student that's not enrolled. So you really have to estimate the standalone selling price of housing if it's not readily observable. And then finally, step 5, recognize the revenue. So the standard setters generally believe that students receive all of the benefits provided by the institution as instruction is provided throughout the quarter or the semester. So it would be appropriate to recognize those revenues ratably over time. So the other thing that the FASB, one of their main goals was to improve the disclosures around revenue recognition. Many of these disclosures are quantitative in nature and hence very entity specific. So there's 5 different points on this slide, and you'll need to be aware of that some are applicable for public entities and some are applicable for non-public entities. There's different levels of disclosure for those 2 different types of entities. So just to give you some general ideas of what will be required, the new disclosures will include disaggregation of revenue. So this could be by geographic region, timing of recognition, customer type, just to name a few examples. Contract balances, so that would be now required to disclose opening and closing balances, revenue recognized during the reporting period, and performance obligations that have been satisfied or partly satisfied. Public entities have to disclose the amount of the price that has been allocated to performance obligations and remaining performance obligations, as well as when you can expect to recognize those performance obligations. And non-public entities actually aren't required to disclose that information. You'll also have to disclose any estimates related to transaction price or allocations to performance obligations. And then any policy decisions that you make regarding the methods used to recognize revenue are also required. So let's talk about the effective dates. So as I mentioned in the intro, the original effective dates were deferred for 1 year. So the deferred effective dates are for calendar year 2018, so December 31st, 2018, and then for our June 30 or September 30 or May 31, that's going to be for your fiscal year 2019. That's for all public entities. So public entities include nonprofits with publicly traded conduit or direct debt. And then for all other organizations and nonprofits, that would be its calendar year 2019 or fiscal year 2020. And early adoption is permitted, but not before the original effective date. So how are you going to implement this new standard? Joining this call and listening to us talk about kind of the overview of the revenue standard is a great start. The key to implementation is really to become familiar with the new standard early. Discuss the standard with your auditors and internally and evaluate the impact the standard will have on all your revenue streams. So it's probably time to take inventory of all those revenue streams and evaluate whether there are differences between what you currently do now as you recognize revenue and what you will be required to do under the new standard. It's also a good time to evaluate your organization's internal controls and determine if any processes need to be modified or whether new systems need to be developed. Consider the impact on your organization's debt covenants. You may have additional liabilities, refund liabilities, kind of like I walked through in the tuition and housing example. Also, revenue may not be recognized as timely as you had previously done. So it's a good idea to actually consider preparing a mock-up of the financial statements to understand the impact. And that could also be used as an educational tool for your board and your finance committee about what the financial statements will look like under the new revenue standard. Finally, as you'll see at the bottom of the slide, Moss Adams actually put out a revenue recognition guide, and it's available on our website, and it can be a very useful tool in helping to familiarize yourself with the standard and help you at your organization implement it. So let's now talk about revenue recognition of grants and contracts by not-for-profit entities. So this project was actually added to FASB's technical agenda to improve and clarify existing guidance. There's been no standard or exposure draft issued yet, so this is just kind of really the beginning stages of new guidance, but we wanted to make you aware of it. It's really asking the question, are grants and contracts within the scope of the revenue recognition guidance, topic 606? So really, despite existing guidance, there is significant diversity in practice on how grants and contracts are recognized by not-for-profits. While this has been a long-standing issue, the new revenue guidance has really placed a renewed focus on it. Some organizations account for grants and contracts as non-reciprocal transactions, similar to a contribution, and some NFPs account for these as reciprocal or exchange transactions. So they're really trying to figure out how to make those uniform. So questions such as under Issue 1, reciprocal versus non-reciprocal, does a government receive direct value in return for the money that they give to your organization? Many people believe that governments don't give contributions. So stakeholders have also expressed difficulty in distinguishing between conditional and unconditional. So also diversity in practice in determining whether The likelihood of failing to meet a condition is remote. If the condition is, if you may not meet a condition, then you can ultimately change when revenue is recognized. So it's really getting at that piece as well. So overall, issues 1 and 2 occur from various types of funders, but government grants and contracts seem to have the most concern among organizations. So first, let's talk about issue 1. So there was a tentative board decision to clarify and refine existing guidance. This was really saying that a resource provider, so say a government entity provided your organization funds, they are not synonymous with the general public, even a governmental entity. So if a resource provider receives value indirectly by providing a societal benefit, this would actually be considered a non-reciprocal transaction or a contribution. It's also really important to remember that the type of resource provider should not override the substance of the transaction. So just because the government provided you funds to your organization, that doesn't always mean it is a reciprocal or a non-reciprocal transaction. You have to really look at the substance of the transaction. So expect more on this specific issue. As for issue number 2, there was a tentative board decision reached in February and then confirmed in April. And what they are really deciding is that for a donor-imposed condition to exist, a right of return must exist, and then a barrier must be overcome. So a barrier would include things like on this slide, incurring qualified expenses, having to meet specific outputs or outcomes. So those are the things that would require it to be a donor-imposed condition. So just the timing on this one. So they're still drafting an exposure draft, drafting the new accounting standard. That's happening in this quarter, second quarter. They expect to issue a proposed update in mid-2017 and complete redeliberations by the end of 2017, and then hopefully have a new standard in early 2018. So be on the lookout. So let's switch gears now from revenue to leases. So this was another convergence of international reporting standards and U.S. GAAP. It began in 2006, so again, a long time in the making. So under this new guidance, a lessee will be required to recognize assets and liabilities arising from all leases with lease terms greater than 12 months onto the statement of financial position. So you'll have to recognize a lease liability and then a right of use asset onto the face of the balance sheet. And there continues to be a differentiation between finance leases, which are your typical capital lease that you've seen forever, and then an operating lease. So this standard was updated to create greater transparency in financial reporting. So just the definition of a lease contract conveys the right to use an asset for a period of time in exchange for consideration. So the first lease up there, the finance lease, that's your typical capital lease. So on the balance sheet, you would have a right of use asset and a lease liability. On the income statement, you'd still amortize the right of use asset, and you'd have related interest expense for the debt. And then on the cash flow statement, you'd have cash paid for principal and interest payments. For the operating lease, you'll still have the right of use asset and the lease liability on the face of the balance sheet, but on the income statement, you'll just have one line item that includes both your amortization and your interest expense, which may or may not be imputed, and that's just combined as one line item called rent expense. And then cash paid for lease payments is what you would show in your cash flow statement. And again, this is for all leases just greater than 1 year. So when is this effective? So for public entities, this is going to be effective for calendar year 2019 or fiscal year 2020. And then for all other entities 1 year later, calendar year 2020 or fiscal year 2021. And then early application is permitted for all organizations. So if you're itching to get those leases on your balance sheet, that is up to you. Okay, so some implementation considerations. It's really important to consider the current financial statement covenants that you may have at your organization and any debt capacity that you need. Because with additional liabilities being recorded that were not previously included or contemplated when negotiating those covenants with your financial institution, that could cause some issues. Your organization will also need to take inventory and identify all arrangements that constitute those leases that are greater than 1 year. We've been pointing our clients to their commitment disclosure in the financial statements. That can give you a pretty good idea of all of your operating leases that are pretty significant to the financial statements taken as a whole. And then it's really just important to ensure that that population is complete. So if you have a decentralized organization, you need to be sure that you're capturing all the leases that may have been entered into by various departments. Then finally, evaluate how your existing systems and processes need to be modified and or developed, how your budgeting process may be impacted by this additional liabilities coming onto the balance sheet. And finally, materiality should be considered. If you have 5 very insignificant copier leases, this standard may not apply to you, but be sure to check with your auditors. So just our final polling question here. So how prepared do you feel to implement the new lease standard? You feel very prepared, you've read the guidance, you feel confident regarding implementation, you don't feel prepared but you plan to take inventory of your leases, or you don't think the standard will impact your organization. I'll give you about 20 seconds here. And just remember, you have to answer 3 of the 4 polling questions in order to receive CBE credit. Okay, let's see. Okay, good. You're not prepared, but you plan to take inventory. That's 52% of you, so that's great. Listening to this webcast is a great opportunity to kind of become prepared, and then really looking at that financial statement footnote that you have in your audited financial statements will help really give you an idea of all the leases that you have out there. Okay, so let's switch gears one more time to the statement of cash flows. So this standard was issued in November 2016 as part of a consensus of the FASB Emerging Issues Task Force, and organizations will now be required to show the changes in cash, cash equivalents, restricted cash, and restricted cash equivalents within the statement of cash flows. So what that really means is that entities will no longer present transfers between cash and cash equivalents and restricted cash equivalents in the statement of cash flows. So basically on your statement of financial position, if you show cash and restricted cash as separate line items, you'll just have to show a subtotal that shows total cash and cash equivalents so that it will reconcile to the ending cash equivalents on your statement of cash flows. When is this effective? So for public companies, this standard is effective for calendar year 2018 or June 30, 2019 year ends. And then for non-public companies, the standard is effective for calendar year 2019 or fiscal year 2020 year ends. And this is early adoption is permitted. So just a few other resources and updates that we wanted to make you aware of. The AICPA did come out with an audit risk alert just recently, and this includes various updates from last year, which are on the not-for-profit financial statement standard, on leases, and then on going concern. As you may recall, going concern used to just be an audit standard. It used to be something that us as auditors would have to evaluate on an annual basis. Now it's an accounting standard, so management really has to evaluate going concern on an annual basis. This audit risk alert will really help you implement those new standards and kind of get you up to speed on them, so we really encourage you to take a look at that. There's also a new updated NFP audit guide, so if your organization is one that obtains the AICPA NFP audit guide, be sure to get the newest version. And then finally, just a couple other recent changes to be aware of. So the OMB recently updated guidance for procurement for the grace period. So now it will be applicable for years beginning on or after 12/26/17. As you may recall, they did issue a 2-year grace period when the new uniform guidance originally was issued. Now they're extending it for 1 more year, which is great news because it is a pretty significant item to implement at your organization. So please don't delay. You take this additional year as time to invest in your organization and be sure that you have the updates made that you need to have made. And then finally, the Yellow Book. They have a proposed update exposure draft out there which contains various items. Boss Adams, I think, is going to be responding to that exposure draft. So if you've had a chance to read it and have any comments or questions, please refer them to us, and we'll be sure that we get them in our response letter as well. So Emily, I'm going to hand it over to you to do some Q&A.
Awesome. Thank you, Ashley. Okay, so we have about 10 minutes left here for Q&A. If you have a question, For our presenters today, you can submit that in the Q&A window to the left of the slide view. And our first question is, related to the liquidity disclosures, can you include donor-restricted funds if they are going to be used in the next year, such as restrictions for scholarships?
Yes, I'll go ahead and take that one. Yes, you certainly could if those funds are available to meet your cash needs within the year for your general expenditures. You certainly could, as long as you're meeting that definition of a financial asset. You absolutely could include those items. The important thing again is just disclosure. Just making sure that you are explaining what you're including and what you're not including. So as long as you're meeting that definition, you absolutely could include those funds restricted for scholarships if they're going to be available and used in the next year.
Great, thank you, Jen. Our next question is, you went through an example of the 5-step process for tuition revenue recognition. Can you give us another example that would be relevant to another not-for-profit?
Sure, thanks, Emily. I'll take that one. This is Ashley. So let's just take, for example, a not-for-profit that has annual dues of $100. And the only benefit members actually receive is a monthly newsletter with a fair value of, say, like $25. So the amount paid for the monthly newsletter would actually be considered a contract with the customer, since this is a reciprocal transaction. You're both getting something in exchange. The remaining $75 is deemed a contribution, since no specific identifiable performance obligation is provided, and so scoped out of the revenue recognition. So in step 2, you'd identify the performance obligations. So the nonprofit, they have an obligation to provide the monthly newsletter to the member in return for his or her payment. So that's the only performance obligation in the contract. And then determine the transaction price. So the fair value of the newsletter is the transaction price, so $25. And then allocate the transaction price to the performance obligation. So the $25 would be allocated to the performance obligation to provide the monthly newsletter. And then recognize the revenue when or as each performance obligation is satisfied. So the $25 would be recognized as revenue over the 12 months as each issue was provided to the member. And the $75 that organization is taking in, that is between the $25 and the $100 that you actually are paid each month, would be recognized as contribution revenue, since there are no benefits provided in return. So no reciprocal transfer means that you recognize revenue. Emily, back to you.
Thank you. Our next question, can you clarify if we should allocate staff time of investment management to internal investment expenses? For example, CFO's percent of time spent on investments.
Yes, great question. I'll take that. This is Jen. Yes, if that CFO is responsible for really executing the investment strategy, selecting, monitoring investment firms, or involved in really generating that investment return, those would be considered direct internal investment expenses, so those should be included as investment expenses. But if it's really just the accounting function, recording the investments to market value or unitizing your endowments, if it's really not part of generating the investment return, those would not be included.
And then a follow-up to that, would we exclude private equity investments as financial assets unavailable within 1 year?
I'll take that one. This is Jen. So I'm assuming this is for the liquidity disclosures. If those private equity investments are available and liquid within 1 year and can be used for general expenditures, then yes, you could go ahead and include those as part of your financial assets that are liquid. It just depends on those liquidity provisions. Many of the private equity investments do have a more than 1 year restriction or lockup. But again, if you're meeting that definition of a financial asset, it's available to meet your cash needs within a year for your general expenditures, then yes, you could include a private equity investment.
Thank you. And looks like we probably have time for one last question. If we did not have a chance to get to your questions today, we'll be happy to follow up with you after the webcast. Our last question is, what if the cash is from a line of credit? Does one, or how would you disclose the line of credit in the table?
Yes, I'll take that for liquidity as well. If it's just a line of credit you have available, but you haven't drawn on it at the statement of financial position date, that would just be something you would include in that qualitative disclosure, that you do have those funds available. However, if you've actually drawn on it and it's sitting in your cash, then you would just show it as cash. But if it hasn't actually been drawn, it would just be disclosure that it's availability, liquidity that you have available.
Great. Thank you, Jen. And I think we're going to wrap up. Again, if we didn't have time to address your questions, we'll be happy to follow up with you afterwards. Thank you, Jen and Ashley, for a great presentation today. Covered a lot of information. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon, and that is to the left of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. And I'll keep the webcast console open for a few moments to give you time to download your CPE certificate now. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.